Welcome everybody to TradeGATEHub.com, powered by TradeView Markets Thursday interview. And today I'm with my trading warrior brother Henrik Zeberg. And Henrik and I have been talking for probably at least the last 4 years or so, 5 years, Henrik. And I always find his work fascinating, at times controversial. He puts up with a lot, like all of us do on the social media realm, because we're not always right, and sometimes cycles invert on us, right, buddy?
Oh yeah,
Yeah.
I'll
So
last longer.
yeah, that's really the art of this is not the if, it's a when, in my book. So, Henrik, great to have you here to edify our community about, a couple of major trading opportunities that are setting up here. A little bit interesting that you're looking for a blow off top. I believe you're talking about equities. So anyway, let's get to this Game of Thrones, and winter is coming in spring.
Right.
Or will winter come in winter?
Sorry?
Will winter come in winter? Well, when do you think we'll be heading into?
Oh, when we will have it? Oh, yeah. No, I think it'll be. I think we'll have winter and summer, or at least the start of the winter will be in summer this time. So, but then
Okay.
as you said quite correctly, that it's sometimes it lasts a lot longer, and definitely I will say after the COVID crisis or the COVID crash, I kind of expected things to unfold there, but we just didn't get to the levels. So that wasn't the end of the winter, and so I definitely expect more. And when I say winter, it's not the Game of Thrones winter. It's the Kondratiev winter that I speak of.
Okay. And, I was trying to think of an analogy for COVID because it interrupted the seasons, right? And I grew up in Chicago, and you go through winter where you live, and it kind of reminded me, even though it was a crisis, that it turned into somewhat of a Indian summer, which happens near the end of fall, where you're going to get could be October in the Midwest, where you're on the cusp of things changing, into fall and winter. So that's what COVID was, not for a million people here in the US, but it just delayed things because of unprecedented action by both the Fed and fiscal moves by governments across the world.
Yeah, so, and I think they probably even made the problem even worse because they went all in, and that's actually some of the things that I have here, and at a time where I think they probably even overreacted to the situation because there wasn't really a demand shock to the kind of degree that they put it up, and yet they came out with a stimulus package. If you take across the world, which was far beyond what we had in the Marshall aid back in after the Second World War. And that was, so it's if you look at it in that perspective, and you didn't see that kind of demand decline. So we didn't even have a proper recession. So that's some of the things that I look at here. And that's why I think also, yes, as you said, Dale, that's probably something that have extended the seasonality here, or extended the period before we're going to get to the point, but they made it a lot worse, and
they piled on a lot more debt.
Yeah, a lot more debt. So and also the exacerbating of the problem with the supply and demand. I mean, you have somewhat of a demand decline, and then you come in and you put this massive stimulus in, which pulls investment and demand forward, and at the same time you have COVID disruptions in the supply chain. So you get, of course, a demand and supply issue there, which is what I think is the main problem of why we see the inflation that we do, and not obviously also of course there's a lot of money has been printed, but you still see the velocity of money is not high. And you would expect that if the inflation was coming out due to the fact that people are kind of throwing money away, then you would expect velocity to pick up.
Great point.
It hasn't. So I think it's a demand and supply thing, and they made that work.
And I think a lot of people are misnaming it by calling it a supply disruption. I'm coming to believe it's more of a supply destruction. And the kind of supply chains that we used to have, just in time, people will not trust that anymore. We have unreliable suppliers because of political issues. And it's going to take years to rebuild this. And I think it's going to be, pretty much not a global thing. It's going to be based upon what nations do domestically and with their allies, but not everyone's going to be an ally anymore. I think we've gone through that window.
No. That's true, and especially we feel that here in the northern part of Germany, as you can call Denmark, right? We definitely feel that we've been so dependent on gas coming from Russia these last couple of years. So
that's nerve-wracking. So let's talk about the blow off first. I believe you want to cover.
Yeah, sure. But so actually, just jumping to your point here, if I go into my slides here, let me see if I can get on. So first, when I talk of winter, I talk of the contraction of winter, and I think there is a lot more in store when we look at that. I mean, we haven't come to the end of that, and the reason for that is really, if I look at some of the ratios when it comes to debt, we haven't reached a point where debt has started to come down. Actually, we have seen debt getting exploded, or moving up much higher over the last couple of years here into the after COVID crisis. So we're not there, and we haven't also. There's other distinct phenomenons that we need to see, or events like the pension fund crisis that I'm expecting also to unfold. And and the yields at extreme lows. Well, we have seen that. But in my book, we're still in a bounce from, and we're going to see those yields roll over soon again. So
you think we could go back to negative rates? I mean, we never were there, but we could go negative. We will.
We were in Europe. Yes, we were in Europe, and we will get even more negative. Yes, I definitely think so. We haven't solved anything. I mean, nothing has been solved. We have kick the can again, a lot of stimulus, and that's actually getting into it. But as I say, I'm still seeing us in the contractive winter, a lot more to unfold. Unfortunately, a few years back, I said I hope we'll not get war, and it's been standing there ever since. And here we are with something of Ukraine-Russia war, which hopefully will not go beyond that. It's terrible enough as it is already.
What do you believe, though? I know what you hope. I know what you believe.
I fear it can spread, and I fear that it will be, not just Ukraine and Russia, but we might see other areas of the world that we will have some geopolitical challenges.
Yeah, I hope the same way you hope, but it's amazing how Kondratiev is how long of a cycle again?
Yeah, they are like 80 years or something like that. It's not on the date, but it's like 80 years, and there are certain indications that tell you now that's an end of a season, and we're not there with the winter yet.
Yeah, but for the war, we are.
For the war, that's one of the indications that's the last part of it. So if you go back in time, you had the last winter. It was the Second World War.
Right.
Before that, it was 1860s, 1870s, where you had the Civil War. U.S. and you had a large German Franco War, and you had a lot of nationality. You had a lot of
ethnic wars.
Yes, ethnic war. We had a small one here in Denmark, but there were and then if you before that, 80 years or 70 years before that, that was the Napoleonic Wars. So it kind of stripped, and what you had all those times was also the same kind of patterns around what the crisis is, how it unfolds, and it's actually a depressionary kind of. One of the greatest depressions you had was actually in the 80s, 60s, and 70s, or 1870s. Which was after a technology boom of the railroad coming out. So nobody really speaks of that anymore because it's so long ago, but it falls into the winter season, which we are in the midst of right now.
I remember.
You remember? All right.
All right, buddy, go ahead.
Yeah. Okay, so what I think that this overreaction that we saw coming out from the COVID, we have here the monetary aggregate, so the M2. And that gives us an idea of how much the stimulus that they pumped into the economy after the COVID. 26% of the money, so to speak, that is in existence was printed during the after the COVID crisis. So that's a stimulus of and that was just the monetary part, and then you had all the fiscal stimulus coming out also. And if you look at it and say, I don't know how much you can see of my screen here if I move this around. Okay, but you also see that, of course, we had a bounce then in GDP, but already here in Q4 of 21, we saw that was rolling over quite significantly. So we created a bounce which have now lasted around 2 years with this, massive and unprecedented kind of stimulus amount size of package coming out, and we also have yield curves now rolling over already. So we are at least the normal indications of a recession that we see, yield curve rolling over, is something that we see already. That doesn't mean a recession is coming tomorrow. So I think the yield curve rolled over before the financial crisis was in September, October of 2006, and the recession set in the quarter of 2007, the fourth quarter of 2007. So it can be another year before the recession. I don't think it'll be that long this time around, but it just tells us that even with this unprecedented kind of stimulus, we already see the economy stalling, and that's what I think is kind of
Yeah, there are people that think we're already in recession, Henrik. Danny Blanchflower, I mean, some of the guys I talk to that are economists say, the definition of recession is what? 2 negative
quarters,
GDP quarters. And so they're always late. I mean,
yeah,
we always find
they are. But you normally would see the stock market having peaked before that. And I know people say the stock market have peaked that, and you will also, there are other indicators also that should be in place. So I would say that we're not there yet, but I would think that we could be at a point where Q4 again in 2022 could be the first quarter of recession. My guess. Yeah.
All right.
So if we look at that, so we are definitely at a point where the economy is rolling over. We have the indications of something of recession coming. And that to my thinking here will be the big one. We have the largest equity bubble ever. So by far, we all know 2000 was a bubble and 2007 was a bubble, and 1929 was on par with 2007. So of course what we have now is a major equity bubble, and in an economy which is now rolling over, and we have yields also spiking up, and the Fed is becoming hawkish. So, what's not to like in terms of, pins for the bubble that could, pop it.
There's plenty of them.
Plenty of them. So it's gonna pop. I mean, that's why I'm not. What I'm then saying is that I don't think we're there yet. And I know that, it's been, at some point I thought it was, okay, they can't really blow this up one more time, but then they did. At this point though, what I think if we look at this, which I use a little for as a timing indicator. So if we look at the SPX versus the TLT, which is a ratio, saying, okay, as long as equities is outperforming TLT or bonds, US bonds, well, we are, risk on kind of environment. And we got a good indicator of a top here in July of 2007, and then it started to roll over, and SPX topped in October of 2007. And we had, also tops here before the Corona crisis. What we see right now is that we have still this moving up. So we have made a new top in April. And that tells me we do not have an outperformance of TLT bonds versus equities. So that tells me we're still in a risk-on environment. And that's why I don't think we are in that January. See that as, or whenever it was that people tell us that we had the top.
That was a high, 48.30 or so was not the high.
And we don't see RSI here rolling over, so I say there's at least a few months worth still of higher highs coming in the equities, and that's where I think and that's the big thing here. And if I look at the SPX, then I think we saw that bottom here in March, which I see as a bottom of wave 4, which gives us. You
guys call that an ending diagonal, right?
This is an ending diagonal, so that's not. So if you get, first of all, what got me, pay notice to this is actually this part here. So you have A, B, C, and that makes it a correctional wave at the top, and that's normally not. That's actually a bullish sign. That's a bullish. So we had the first decline, a bullish correction on the correction, and then you had a ending diagonal here, which even does not even get down to the low of it, which again is a bullish sign. So the blow off top. If I take and go further back and so this is wave 3 ending here, 4th here. If I take the length of wave 1 and apply that on the 5th one, which is normal when we have the 3rd as the longest, well, then we could end up at 5,600 on the S&P. And that could be a quite significant, strong move into maybe only June, but perhaps also later this year. But I would say June is my guess. And I don't think, so what we've had now, we had the move up first, we had the second wave, and I'm, right now counting on a very, very strong move for for April. I think April is going to be fantastic for equities into May. maybe a pause around the time of the FOMC in early May, and then the last blow off top into June.
Do you see many? Can I just interrupt you a second? I know you're looking at pretty close to the 2.618 extension, and that's I know a lot of people like that, the 1.618, 2.618. Have you ever seen 3.618s? Like you have it up there?
Yeah, sure. I don't think that would be the case here, but that could, of course, it could happen in extreme coincidences, of course. And with wave 3 as the longer than wave 1, we could easily see that it could go higher than that. But if I have to guess, it's already a Surpass. Once this is not the 261 on the first wave. That's actually just on this one here.
Okay. Yeah, I got it.
So this line coming in here up here is the wave 1 down from March of 20. Into when was it, October of 20, I think, or something like that. That's give us this high here. So that's the 5,600, and that's okay. My best guess for a top in and coming in mid this year.
Okay, like it. Nice look. I think a lot of people would be happy with 5,500.
Yeah, right.
But
right.
I think don't you think a lot of the stocks that have given up like 70-80% are broken stocks, even though the market's going to make a new high? That a lot of these will just recover?
I think that we're going to see a different scenario from what we're seeing. That I can show that in if you look at the emerging market, and if you look at the small caps and you look at others, actually I think this is not what people expect right now. And very often
it's not going to be only FANG again.
No, it's not. It was only the FANG stocks. If you look from last year of March into this year, that's only been the FANG stocks. Almost, right. But if you look from the period of March low, 20 low, into March of last year, you actually had, and this is the IWM versus the SPX.
Right.
What we have here, so that's another ratio saying when this moved up, it's meaning that the small caps outperform large caps.
Right.
And what you have here is a clear ABC. That means it's a correctional wave, and what you have here is then another ABC. To me, at least, that's what I see.
Okay.
And I think we're going to need to see another C wave here. So the entire A, B, and C will be a B wave before we see the crash.
Okay, and aren't the Russell, small caps considered more speculative? So it would make sense that they get the attention during a speculative blow-off phase.
Exactly. And the reason for, and this is what this tells me. So if we touched down on this one, we had the first wave, the second wave. I think we're about to see small caps do tremendously well during April and into May also. And have the final top around, mid-June. So a strong move like what we saw over here. So it will not be anything like what we have seen over the last year. So we have to think which stocks did well in that period of time. So from March of 20 until the March of 21, that year we need to look into. And the reason, as I see it, is actually that we have I will get back to that, but first say this is just an example. Palantir Technologies, and that's one of the small caps that I hold. Again, right. I see the similar kind of the correctional wave. This is correctional to me. So A, B, and 1, 2, 3, 4, 5 breaking up, and I think it's going to do tremendously well. And I see other stocks like that also.
How about some of the cannabis issues that have been ignored?
I'm also long 4, 5, 6 even cannabis stocks. I got.
See, Mike. All right, go ahead.
Just
an argument. I mean, if the market's going to get that high, why not cannabis stocks go up?
Yeah, right. But I hold some of them as well, and I bought in more.
Right.
And I saw it just went through the House, right, and the in terms of legalizing it in the U.S. So that would be
good.
Anyway,
rock and roll, buddy, rock and roll.
Rock and roll. But what I think is going to drive it, Dale, is not going to be legislation or anything like that. I think, why are we, in store for all-time highs on the equities? And first of all, if we look at the credit impulse coming out of China right now.
Yeah, they're easing.
Yeah, they're easing a lot. And it's actually, one of the highest moves we've seen for a single month. So there's, more credit coming out of China. At the same time, I see, and that's what I have on the next chart here. I just want to put up the headlines first. Dixie is topping out at this point here. I see the Dixie declining from where we are at right now down to around 94. That means that'll help. And I also think that bonds or yields are topping out at around this point here. If you put those three together, and if any kind of positive news also could come out of Russia or anything like that, or Ukraine, we don't even need that. But
they're all tailwinds that haven't existed. We've had a strong dollar. If it pulls back, that's a tailwind. Everyone's been complaining about higher yields. They come down, that'll be a tailwind.
Yes.
Okay.
And then you have a speculative moment also, as you say, okay, so things start to move up and people will jump into it. And by the end of it, it will be where everybody's long the moment when the market turns. So I think it's now, and I think it's into, as I said, into June or something like that, because imagine if the market doesn't rally into May, and you will see that it doesn't even start to decline too much after that. People will say, okay, this market is invincible. We really are in new territory, and we can.
It's a new paradigm. It's different this time.
Exactly. Yeah, and we will not.
Yeah.
So, and that's what I see. So, if you look at the Treasury, this is the 20+ year Treasury bonds, getting really close to that bottom. I mean, I think yes.
You know where Henrik? You know where the DSI was? I think on Monday. That's it's a sentiment index, daily.
It was 5.
It was 5. Have you ever seen the 5 reading?
No, I that's what I'm saying. Also, I think I put that in a tweet. Also, I said 5 on it. So, and again, correctional to me, this kind of setup here. So that
what a move this is going to be.
It's going to be a fantastic move. Yeah, and it's
because people have declared the end of the bond market, the end of the bull in the bond market. But this is going to surprise a lot of people.
That's exactly what we need. That's what we need to hear, and that's when we get along, right?
Yeah.
So, so I think, and if you see that. Again, paired with what we said before, the weakening dollar and also the credit impulse from China, there's plenty of room for this to move up, especially because I don't agree that we have seen that we don't have recessionary PMI numbers yet. We don't have seen, there are other things that we need to see in a recession. We're getting close, and we're getting even closer in Europe, I think.
Would this portend a significant top in USD JPY?
Yeah.
If we get this kind of yield move,
I think it'll be a correctional move only there. Yeah.
Okay.
I expect much higher level there as well. So
okay.
This is just the dollar that I see. What we actually we did call the bottom back in January on this January 6th of 2021. And you've had exactly this nice move, third, fourth wave, and then had this last up to the 5th of the third wave. Right up to this, a lot of resistance up here, and getting another move like this down here, like what we had over here, before we move higher, is what I expect. I see the Dixie moving higher. I see 111 as a minimum on Dixie, which will of course hurt a lot. But for now, I think it's gonna go. And also, I had another DSI sentiment there on. It was 90s. I think it was 90s, 94, 93. The other, right? Yeah. So that's. So I say that's where we're gonna, and you also have negative divergence, meaning lower top of momentum. So a lot of indications that we could potentially turn here, and that could send the equities higher. Okay. But what I think is the most important thing here is that now everybody's saying, why then deflation? Why should that come from? And what I think is the big mistake and misunderstanding here is that you have this inflation pendulum. And if you look at it, we got into the Corona crisis, and we had the supply disruption or destruction, as you said, and then we had this massive impulse in terms of demand, the stimulus coming out, which created this impulse in the market. Okay, we a lack of supply, and what happens when you have a lack of supply and a lot of demand? You will see every manufacturer I know of and every company I know of are building capacity. They build capacity because they're saying we're doing great. We sell and we are fantastic in what we do, so we build capacity. And what happens then when the stimulus starts to wear off? Well, we then see that the consumer starts to spend less. We see the price hikes that we have seen, which will also take the peak off consumption. And the same goes with rates. And what happens then? You have a lot of supply, a capacity being built, and all of a sudden the pendulum swings to the other side. So then you'll start to have oversupply instead of excessive supply instead of excessive demand, and that's what's happened. And that's where you see.
Okay, could there be an exception? I can understand how that could happen with, things that are manufactured. how about for things that come out of the ground? Is there going to be deflation when we have crop shortages and droughts, floods, acts of nature, acts of war, just where yields aren't as good, and it's costing farmers a lot to even plant because of the cost of fertilizer. But the drought being the major concern, that I don't care what rates or how weak an economy is, people are still going to want to eat, and I don't see that supply coming back for a while.
There's absolutely I agree with you. There are absolutely reasons why we wouldn't see that. But I think when it comes to things, especially situations like that, it's just like with what we saw after the COVID crisis. When smart people moves back and say, okay, we cannot have a food shortage problem in the world. Things will be, there will be done, things to make sure it doesn't happen. So, but you're right. Of course, lights or red lights there to exact that situation. But we also have the hawkish Fed coming in and pulling stimulus, the stimulus back, and what is it? Quantitative tightening now at 95 billion per month is what they are aiming at, and that's a lot. And I think we're also in a situation where we have seen inflation very, very close to topping out already. So if we are in that scenario, we could easily see a scenario where deflation is actually coming instead of inflation. And I think that is the case. That's going to be the situation. But I agree with you. There are these small, red lights. Not sure that it will carry, with the. You're right. Manufacturers are the ones that have been building supplies and so building capacities. But the economy kind of also have. I have a friend who works in the Danish Statistical Bureau, and he says it's interesting because the last 2 months we have actually seen the inventories being built up, on a national level. And if that's the case, that could be the first signs of they actually have a oversupply, or supply has been bouncing back.
Right. Okay.
So, and I think that's the inflation pendulum. As far out we've been on the inflationary part, I think we're going to see on the deflationary part. And that's why I think, we're going to see also the Fed come back at some point and try to rescue everything again. But this time, I think it'll not just be the Fed. I think helicopter money or the kind of stimulus checks you've seen in the U.S. is going to come out at a greater.
What they call that, MTM? What's that called? Where they just pay people a universal income? You think that's next?
UBI, right? Universal Basic Income, I think it's called, right?
Yeah.
And I think something like that could easily come out. But in terms of the timing, and if I look at the Russell 2000, I kind of like that chart because it has this parabolic kind of look to it. So where we're at right now, I think we're at here the fourth bottom here, and we're going to see this strong move, which will resemble what we saw back here into that final top. And this resembles also what I see at the emerging market chart, which is very, very clear to me, actually, that this will be a major, major top. And the only thing we can see there is that return to, more sane levels. Yeah. And to me, an A, B, and C on the entire. So it will be a reversal on the entire bull market we've seen since 2000. And if that's the case, we could easily see that 75-80% crash in the IWM or in Russell. And that's what I expect. I know that's insane, but nothing. These are reversal structures. Sorry, and if that comes out just drops below that trend line, we're not there yet. I think we need to see that one more high in the blow off top.
Yeah, have fun on that. Enjoy what's coming. You do the right thing today, tomorrow takes care of itself.
Right.
Right. So do you have what are metals going to do during this time frame? Are they going to go up with the blow off in the market?
I think I'm still I have to say that when shit comes to shove, or what do you say, that we're going to see this this crash in the deflationary bust, we're going to see metals come down a lot. I mean, it's to me, we've seen the top in gold in August of 2020, and to me, that's still part of a larger correctional wave which started in 2000 and what was it, 15 or something like that, right? 2015 into 2020. I think they're going to come down, and I think it's going to. I still stand by my below 1,000 on the on the gold.
I'm just thinking between now and June, July, does it rally with the market, or does it come off with the market going up because people move back to things like the Russell instead of oil and gold, miners and oil shares?
I think if it's a risk-on kind of event, I mean, I'm not sure that you want to see. I don't think you will see gold as much. I mean, I'd rather see Bitcoin and cryptos move up with that because they move more like risk assets. So I wouldn't see gold too much or silver like that. But I do see still gold hitting maybe almost 2,000 on the before we see that. But that could be within a couple of weeks. And I also think that silver may hit around 28.5 or something like that, and GDX 42 to 44 before we see those.
Okay,
we're almost there, and the actually GDX is a very nice rising wedge also. So and that tells me also that it's going to be a reversal at that point, and that means that we are so far. If you look on the GDX from an all-time high, that we are not at the everybody talks of a stagflation here. And if it was stagflation and it's been on here for 6 months or how long it should be going on for now, you would have seen gold and silver explode from here. And we haven't seen miners explode. So my point is, if that's not happening, if it doesn't smell like it doesn't look like it, it's because it's not that. And that's where we will have to say, well, it is a spike in inflation due to supply and demand challenges, which is going to come, rolling back due to the inflation pendulum. And we're already seeing that kind of the structures of the silver and gold, which tells me that when we go the opposite and extreme on deflation as we are in inflation right now, well, silver and gold will do really, really badly.
Okay, Henrik, for people that want to follow you, I know you publish a report, the Zeberg report. There you go.
Yeah,
go ahead.
Yeah, sure. So we got the CFDs.com, and we also just opened a community on Twitter. So you can go find that. They're called the Zeberg Report, where simply with the subscribers can join in. Something we opened yesterday. We only got 19 or 25 or something members for now, but I hope that all the subscribers will coming in. And it's simply where I'll be tweeting more. And of course, we also have the Zeberg Report, where every Sunday we have a live show, and where we have charts requests, and I give an update on how I see the macro situation. And we also have a midweek video where I tell a little about how I see the market. So these are the things we supply there.
Well, Henrik, I consider you a very interesting thinker about what's happening in the markets, and you have my respect, and I'm always rooting for you, right or wrong in the markets. You lay it out on the line, and you're tough. You put up with a lot of baloney sometimes on Twitter, but I want to let you know, Dale Pinkert's a fan.
Thanks, Dale. Likewise.
All right, buddy. So thank you for edifying TradeGATEHub again, Henrik. Really appreciate it. And let's ride this blow off.
That's
Have
right.
some fun. And then get short and make that FU money.
Right.
All right, Henrik. Thank you very much, buddy. That's a wrap. I hope everyone enjoyed Henrik. Follow him at the minimum at Henrik Zeberg and check out his work. And that's going to be your wrap. I hope everyone has a great holiday weekend, Easter, Passover, and we'll see everyone on Monday to lay it out on the court again. Good hunting. Adios. Thank you, my trading warrior brother.
Thank you.